Hello, good afternoon. My name is Ubshet. As I promised last time, I'm going to present the second part of investment environment in the capital market. So I hope you will get my last video presentations and very helpful. And once again, I will ask you to write your comments and to subscribe my video if it's worth for you. And in the second part of my video presentations on the investment environment, I'll try to cover the issue of investment process, how the investment process in the capital market will undertake, and the competitiveness of the market structures of the capital market, as well as who will be the players in the capital market. So I will try to introduce each and specific pointers briefly. So the investor portfolio, as we already discussed last time, is just the collections of investment assets. It is not a single kind of asset, rather more than one asset can an investor can hold. So in a collective manner, we call it the portfolio. And once the portfolio of the investors is constructed, it's not a kind of static issue. Rather, there is a dynamism on the investment environment. So it needs to be updated or rebalanced because of the following three pointers. The first one is the investors may sell the existing securities. By doing so, the proceeds he use the profits to buy a new securities. The second one is by investing in additional funds to increase the overall size of the portfolio that the investors hold. And the third one is the investors sometimes may say this existing security if you wish to reduce the size of his portfolio. So investment assets can be generally categorized in a broad manners like a stock, a bond, real estate, or a commodity, and any kinds of investment assets. So investors make two kinds of decisions in constructing their portfolio. The first one is the asset allocation decisions, which means the choice among the broad kinds of asset classes that we mentioned the above. That means the stock, either the stock, the bond, the real estate, or any kinds of commodity. The investors must decide its allocation. The second one is the security selection. This is specific and particular kinds of choice that an investors need to make among the those stock in order to construct the portfolio of the investment. So in making these two kinds of decisions, the investors either use a kind of top-down approach or a bottom-up approach. But in the case of the top-down portfolio constructions approach, the investors or an individual, for example, currently hold its all amounts of capital, money capitals in the bank, and he needs to decide what proportions of its capital going to the stock, the bond, or any other asset. So it is the way of the broad futures or the bigger picture of the portfolio constructions or establishment. Treasury bills are generally believed to be effectively risk-free because you know the interest rates you will earn when you buy them. The interest rate is decides previous to buy your treasury bill, so you are sure how much interest rate you get from the treasury bill that you buy from the national bank or other government issues. Therefore, the decisions to allocate your investment to the stock market or to the money market where treasury bills are traded will have a great complications for both the risk and the returns of your portfolio. As a result, the top-down investors first make this and other crucial decisions, which is the decisions that we already mentioned above, before turning into the decisions of the particular or specific securities that they want to hold. In this process, the security analysis is mandatory, which means it involves the valuations of the particular security that might be included in the portfolio. We need to make evaluations on individual securities in our portfolio construction decisions. So bonds and stock must be evaluated for the investment attractiveness. But valuations is far more difficult for the stock market or stock performances, usually because far more sensitive to the conditions of issuing firms. Stocks are by its nature very sensitive, so the valuations or the security analysis on the stock market is very complex and it needs a critical thinking. So in the bottom-up strategy, the portfolio is constructed from the security that seems attractively priced without as much concern for the resultant asset allocation. Such a technique can result in unintended bits on one or in another sectors of the economy. For example, it might turn out that the portfolio ends up with a very heavy representations of the firms in one industry or from one part of the country or with exposed to one source of uncertainty. However, bottom-up strategy does focus the portfolio of the asset that seems offers the attractive or most profitable investment opportunity. So in the investment environment, the other important issue that I want to share with the markets are competitive. Financial market by its natures are highly competitive and thousands of intelligent and well backed analysis. Consequently, securities market searching for the best buys. They are very intelligent analysts, forecasters who are dealing with the security markets to get profits out of the market process. So this competition means that we should expect to find few, if any, free lunch securities that are so underpriced that they represent obvious bargains. And this non-free lunch propositions has several implications on the capital market. Let us examine two of them. One is the risk-return trade-off. By the nature of the human being, investors invest for anticipating future returns. We invest our capitals because we are expecting a more benefit in the futures. But this return really can be predicted or rarely can be predicted precisely. Our predictions about the returns of the investments may not be always true. It is rarely predicted precisely. There is always uncertainties in our predictions of the future returns of the investment activity in the capital market. So there will almost always be a risk associated with the investments, and actual or realized returns will almost always deviate from the expected returns. The returns that we expect when we invest our capitals to the market may not be exactly fit to the returns that we get at the end of the investment period. So there is always a deviations between the expected and the real returns that we get. Naturally, if all else could be held equal, investors would prefer investment with the highest expected return. As a human being, all investors prefer to invest on the securities that will bring a higher amount of returns. However, the non-free-lunch rule tells us that all else cannot be equal. Cannot be equal. If you want a higher expected return at the end of the investment period, you will have to pay a price in terms of accepting higher rate of investment risks, which means if you need higher amounts of return from your investment activity in the capital market, you also need to face a higher amounts of investment risk, which means risk and investment returns are directly related. So there is no free lunch principle. If a higher expected return can be achieved without bringing extra risk, there will be a rush to buy the high return assets, which results that their price will be driven up. An individual consider investing in the asset that now the higher will find the investment less attractive. It is price will continue to rise until the expected return is no more than proportionate with the risk. At this point, investors can anticipate a fair kinds of return. The return or the profits that the investors will get will be fair after adjusting the deviations between the price, the lower price, and the returns of the asset. Similarly, if returns were independent of risk, there will be a rush to selling high risk assets and their price will fall. And if the supply of the security is getting much higher or abundant, then the price or the buyers will force them to give a lower amounts of price for each security. So the asset will get cheaper and improving their expected future rates of returns until they eventually were attractive enough to be included again in the investor's portfolio. We conclude that there should be a risk return trade-off in any security market, with a higher risk asset priced to offer with the highest expected return than a lower asset. Of course, this discussion, our previous discussion, leaves several important questions unanswered. The first one is how should one measure the risk of an asset? How can we measure the risk of an asset? If risk and returns are directly related, how can we measure proper risk? The second question is what should be the quantitative trade-off between risk or the proportionate measures and the expected return? So the quantitative issue will also come to the front. I will show you how the quantitative analysis methods will apply to properly measure the risk and returns and the quantitative trade-off between those the risk and the risk and returns that the investor will face in the capital market after my four presentations, which will be highly quantitative. So one would think that risk could have something to do with the volatility of the asset returns, but this just turns out to be only partly correct. Even if we assume that risk can be measured by the volatility of the asset returns, it may not be the total or the perfect answer for these questions. Because when we mix assets into diversified portfolio, we need to consider the interplay among the assets and the effects of diversifications of the risk and the entire portfolio. So diversification means that many assets are held in the portfolio that exposed to any particular asset is limited. So if, as we diversify our assets, the risk that we face in the total portfolio will be minimized. Because if we get a loss in one asset, there may be a profit on the other assets, so there will be a balance. So diversification is one of the important issues in the asset market. So a wise investor may not be hold an asset from a single asset, rather they prefer to diversify it. This is one of the risk management mechanism. The second important thing is it is assumed to be the market is efficient market, which is another implications of the non-free lunch propositions, is that we should rarely expect to find the bargaining in the security market. The theory of efficient market says that an evidence concerning the hypothesis that financial market process all available information about the security quickly and efficiently. That is, the security price usually reflects all the information available to the investors concerning its value. According to the efficient market hypothesis, as the new information about the security becomes available, its price quickly adjusts so that at any time the security price equal to the market consensus estimated of the value of the security. But in the real world, this may not be working. If this were so, there would be neither underpriced nor overpriced security. If the efficient market hypothesis is really functioning, there is no underpriced or overpriced security, and there is no need of the security analysis. But in the real world, the efficient market hypothesis is not perfect. One interesting implication of the efficient market hypothesis concerns the choice between active and passive investment management strategy. Let's see the first one, the passive investment management strategy. Sorry. The passive management calls for holding highly diversified portfolio without spending efforts other resources, attempting to improve the investment performance through security analysis. Rather than doing a highly sophisticated security analysis, in the passive investment management, the investors just simply diversifies the securities that he holds. As I already told in the previous slides, if one security is getting down, the price of one security getting down, the price for another security may getting up. As a result, the investors may not be in a total loss. Rather, the loss is the profit may be compensated in the case of the passive investment management activity. The other or the second one is the active investment management strategy. It is just an attempt to improve the performance of the security either by identifying mispriced security or by timing of the performance of the board assets. For example, increasing one commitment of the stock when one is bullish on the stock of the market. So there is a need of a series of security analysis in the case of active security management. If markets are efficient and the price reflects all relevant information, perhaps it is better to follow the passive kinds of investment strategy. If the efficient market theory is working, there is no need of following active investment management strategy. Rather, the passive strategy is very, very useful. So if efficient market hypotheses were taken to the extreme, there would be no point in active security analysis. That means if efficient market hypothesis is believed to be perfect and realized, there is no need of active security analysis. So without ongoing security analysis, however, the price eventually will depart from the correct or values, creating new incentive for experts to move in because of the completely applicability of the efficient market hypothesis. Therefore, even in the environment as competitive as the financial market, we observe that only near efficiency and profit opportunity may exist for especially aligned and creative investors. The other important point in the investment environment of the capital market is the players. Who are the players in the capital market? From the just a brief or a bird's eye view, there will be appear to be three major players in the financial market. The first one is the firm. The firm are the net demanders of the capital. They raise the capital now to pay for investment in the plants, in the equipment. And the income generated by those real assets provides the return to the investors who purchase the securities issued by the other firm. So one of the players in the capital market is the firm. The firm is just they demand the capital either to create a new investment activity or to expand the existing activity. The other is the household. Household are typically the net suppliers of the capital. Household are the savers or the net suppliers of the capital. So they purchase the security issued by the firms that needs to fund household purchase securities that issued by the firms by expecting the future return from the security. The third one is the government. The government can be the borrowers or the lenders depending on the relationship between the tax revenue and the government expenditure. If the government expenditure is higher than the tax revenue, the government may be a borrower. If the tax revenue is higher than the government expenditure, the government may be a lender or a supplier of the capital to the market. So corporations and the governments do not sell all or even most of their securities directly to the individual. For example, about half of the stock is held by large financial institutions such as pension fund, mutual fund, insurance companies, and the banks generally in the world. So these financial institutions stand between the security issuer, which means the firms, and the ultimate owners of the security, the individuals investor. For this reason, they are called the financial intermediaries in the capital market. Similarly, corporations do not market their own securities to the public. Instead, they hire agents called investment bankers to represent them to the investing public. So financial intermediaries, in the case of financial intermediaries are important because one, household want desirable investment for their savings. As a household, we need to have an investment activity that can bring us the best profit or return from our purchase of the security. So yet a small, since households are small and disaggregated, a small or financial size of most of the household makes direct investments more difficult. For as an household, direct investment to security may be very to the market may be difficult because the size of the income or the saving is very small. Two, there are also, on the other hand, small investors seeking to lend money to the business that needs to finance investment, doesn't advertise in the local newspaper to find willing and desirable borrowers. There is also another parties called small investors who need the money, but it is difficult to advertise their needs of the capital and getting that capital. Moreover, an individual lenders would not be to diversify across borrowers to reduce risks. as an individual, it's very difficult to make analyze and diversify the money across different kinds of borrowers in order to reduce the risk that will be lined with the capital market. In the for this, an individual lender is not equipped to assess and monitor the credit risk of the borrowers. Identifying the credit risk of the borrowers by individuals is also a difficult issue. As a result, financial intermediaries needs to bring or to exist. For this reason, for the four reasons that I mentioned previously, financial intermediaries have evolved to bring the suppliers of the capital of the investor together with the demanders of the capital, primarily corporations and the federal governments. This financial intermediary may include the banks, the investment companies, the insurance companies, and the credit unions. So financial intermediary issue their own security to to purchase the securities of other corporations. For example, a bank raises funds by borrowing or taking deposits and lending that deposit to the other borrowers. And the spread between the interest rates paid to the depositors and the rates that charged to the borrowers is the source of the bank's profit. So the lending rates and the saving rates are different. For the difference between the lending and the saving rates is considered to be the profits for the bankers. In this way, lenders and borrowers do not need to contact each other directly. Instead, each goes to the bank, which acts as an intermediary between the two, and the problem of matching lenders with the borrowers is solved when each comes independently to the common intermediaries. So financial intermediaries are distinguished from other businesses in that both their assets and their liabilities are overwhelmingly or totally the financials. The contrast arises because intermediaries simply move funds from one sector to the other sector. In fact, the primary or the social functions of the intermediaries are channeled household saving to the business sector. That means moving the funds from one sector to the other sector, from household saving to the business sector. Another examples of the financial intermediary are investment companies, investment companies, insurance companies, and credit unions. All these firms offer a similar advantage in their intermediary role. First, by pooling resources of money of small investors, they are able to lend considerable sums to large borrowers. The second is by lending to many borrowers, intermediaries achieve significant diversification, so they can accept loans that individually might be too much. And the third is intermediaries build expertise through the volume of the businesses and can use the economy of scale and scope to access the monetary risks. So investment companies which pool and manage the money of many investors also arises out of the economy of scale. Here the problem is that most households' portfolio are not large enough to spread across a wide variety of securities. So the smallness of the size of the portfolio in the household is one of the problem. In terms of brokerage fees and research costs, purchasing one or two shares different firms may be very expensive. So there is a brokerage fee as well as research costs to participate on the different kinds of portfolio, and this may be very difficult for individuals, households, and mutual funds. The other kinds of funds, mutual funds, have advantage of large scale trading and portfolio management, with the participations of the investors are assigned a prorated share of the total funds according to the size of the investment. So these systems, that means the mutual fund systems, gives small investors advantage. They are willing to pay for via a management of the mutual fund operators. So investment companies also can design a portfolio specifically for a large investors with a particular goals. In contrast to mutual funds are sold in the retail market, and their investment philosophy are differentiated mainly by strategies that are likely to attract large number of clients. The other thing is, like a mutual fund, there is also another kinds of fund holder. That means the hedge fund also pool and invest the money of the money clients, but they are open only for institutional investors such as pension funds, endowment funds, and the wealthy individuals. And they are more likely to pursue complex and higher risk strategy. And they typically keep the proportions of the trading portfolio as a part of their fee, whereas mutual funds, they set a fixed amount of percentage for the assets to undertake the management. The other important thing is economy of scale is also explain the proliferations of the analytics of service available to the investors. So newsletters, database, and brokerage house research services all engage in the research to be sold to the large client bases. Since I already mentioned in the previous informations have a big role in the capital market, since it is a kind of game theory, we may lose or we may gain based on the information, the amount of information that we have available on hand uh, during the time of purchasing and selling of the stock or the share that we have on the market. So that information may not be available for every individual. So the information may be analyzed, compiled, or find of researchers. So the research may be kinds of newsletters or a database, and a brokerage house research service also may be established to provide such kinds of research findings to make a proper kinds of decision. So this setup arises naturally, and investors clearly want information, but with a small portfolio to manage, they do not find it's economical. For small investors, getting such kinds of information, the research findings is very difficult, and it may not be economical to personally gather all of his profit opportunity in money. And a firm can perform this service for many clients and charge for it. There is maybe a need of existence of a firm that conducts such kinds of informations and researches and creates and establishes a database to provide that information for individuals, investors who are willing to participate on the capital market in terms of the fees. The other is investment bankers. Just economy of skills and specializations creates a profit opportunity for financial intermediaries. So do this economy. It creates a niche for firms that perform specialized services for the businesses. There is, when we establish a capital market, there is also a niche will be created for firms to perform such kinds of specialized service, in data service, information service about the capital market, about the trading, the valuations and the like. And those specialized kinds of service will be provided by either investment bankers or specialized institutions or licensed individuals. So firms raise much of their capital by selling securities such as stock and bonds to the public. Because of these firms do not do so frequently. However, the investment bankers that specialize in such can offer their services at the cost below that of maintaining an in-house security issuance divisions. In this role, they are called underwriters. These investment bankers, we call it underwriter because of the specialized service that provides to the participants of the capital market. So investment bankers advise the issuing of the corporations on one, on the price it can charge for the security issued, two, the appropriate interest rate, and so forth. So investment bankers can advise these two issues in the other relevant important issue. So ultimately, the investment banking firms handles the marketing of the security in the primary market, where the new issue of the securities are offered to the public, and later investors can trade previously issued security among themselves in the so-called the secondary market. It's not only on the primary market that the first security are issued, but the investors can also exchange the already securities that's on its hands. We call it on the secondary markets. The other important thing is the venture capitals in the private equity. While large firms can raise funds directly from the stock and the bond market or the capital market with the help from their investment bankers, but smaller and younger firms that have not yet issued security to the public do not have the options. Larger farmers who already issued the security can be benefited from the capital market, but smaller farmers may not have such kinds of opportunity, or they may not be reached to the levels of issuing the security. So startup companies rely instead on the bank loan and investors who are willing to invest in them in return for the ownership stake in the firms. And the equity investment in these young companies is called, we call it the venture capital. Source of the venture capital are dedicated venture capital funds, wealthy individuals known as angel investors, and institutions such as a pension fund may be the source of those young firms, because they may not be benefited from the capital market, since they cannot have the capability to issue the security by competing with the large company. So most venture company funds are set up as limited partnerships, and the management company starts with its own money and raise additional capital from limited partners such as the pension funds. And the capital may then be invested in a variety of startup companies. And the management company usually sits on the startup company board of the directors and helps to recruit senior managers and provides the business advices. And it charges a fee to the venture capital fund for overseeing the investments. After some period of time, for example, 5 years, 10 years, and the fund is liquidated and the proceeds are distributed among the investors. So venture capital investors commonly takes an active role in the management of the startup firms. Other active investors may engage in a similar hands-on management, but focus instead on the firms that are distressed, or firms that may be bought up, improved, and sold for the profits. Collectively, this investment in the firms that do not trade on the public stock exchange are known as the private equity investment. So this is all about today, about the investment process and the players on the the players on investing in the capital market, as well as the natures of the capital market. I hope it will be very useful for you. You can add and complement to these presentations, and I hope you'll get it very useful. You can write your comments if you like it. You subscribe to my video. I will share another video for the next weeks, and thank you for the timing, and have a nice time.